Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is ANSYS Inc., ticker ANSS. Over the next 5 minutes, I will talk about what the valuation of this company and what I think of the business quality by using my quick FS tool. So first up is industry. This company is in the software industry, normally quite attractive, and I immediately see that market cap and EV are the same, so I'm thinking this is going to be either a debt neutral or cash neutral company. So ANSYS develops and markets engineering simulation software and services worldwide. That immediately sounds like quite a good business. There's probably some lock-in to doing that. They have the ANSYS Workbench framework in which you can build simulation technologies, multiphysics, heat transfer fluids, electronics, etc. Let's see. So we have the SCADE product suite, ANSYS Granta. Has a collaboration with Velodyne, develops software models of next generation LiDAR. So various amounts of different high performance tools and product suites. It sounds like a pretty good business to be in. Neither the beta or share turnover tell us much. Those are pretty normal for S&P 500 companies. Now, return on invested capital. We can see simply here instantly that they've been profitable every year for the last 20 years. I like that. That's a good sign when a company doesn't lose money. So that's a plus in the column of a high quality business. Now it does look like returns have fallen a bit over time, but they've normalized it around this 10 to 12% range. Let's call it 12%. 10, 11, 12%. 2018 is an outlier, but basically in the 10 to 12% range is where they're getting returns on invested capital. It's also fairly stable, primarily from 2010 to 2017, and maybe some deterioration since then, but with COVID, it's kind of hard to tell. It could be that we're in a pretty good business range for return on invested capital. Now, I like what I see there, but you also see with return on equity and return on invested capital being the same, that they're not leveraging up this business. Perhaps they could get higher returns if they took on some debt here. Now, the valuation at 59.7 is immediately concerning. That is way too high to pay for a business. So my first thought is this is a relatively overvalued company, but we need to put it in perspective of the CAGRs. However, price to sales of 14, anything of a price to sales over 10 is immediately a no for me, so I would not buy the company at this price. This is simply too high a price to pay. I would never pay more than 10 times sales, and you can see that with this PE. I mean, the company could drop by 75% and still only have a PE of 15, which would be relatively normal for S&P 500 companies. Now, your revenue growth is around 10%. You can find 10% CAGR companies growing at 10% that have PEs in the 15 range. So there's not really much of a reason to pay this high of a PE ratio for this amount. Now, why is this PE so high? It's probably because it's a software company and the idea of recurring revenue and lock-in is really big right now in the market. It's very popular, so that's why you're seeing these high rates here. So gross margins are very high. Again, as a software company, you see a lot of lock-in, a lot of stability. I don't really see gross margins decreasing at all. So again, high quality company. I'm liking what I see. There probably is a lot of recurring revenue here, but right now you're just paying a very, very high price for it. So your earnings per share has more than doubled. So that makes about sense. You know, they've gone up 10% per year. Return on equity is in the acceptable range, but not startling high. Let's see what our income statement can tell us. So shares outstanding have declined over time. That's good. That's relatively rare for a software business. So they are buying back shares. They're not issuing a lot of shares. I like seeing that. Are they paying dividends? We're going to have to go check elsewhere. Balance sheet. Let's see if I'm right on my debt. So they're not really holding much long-term debt. You see about $754 million, but they have about that in cash. So the net debt is about zero. So I like it. It's not really leveraged. They have the potential for future leverage. That's a good sign. If we go to the cash flow statement, they are providing stock-based compensation. So they are diluting over time, but it looks like they're steadily buying back those shares as well. So you can see that even though they do have some dilution built in based upon the stock-based compensation, that they're buying it back. So I like the management. The management's clearly making good capital allocation decisions. They're buying back your stock. They aren't paying dividends, which is a little concerning because they're making a lot of acquisitions here, and that's not really turbocharged their growth. So they're acquiring companies at a higher rate than their cash flow from operations. which would be fine if it was turbocharging their growth, but we're not seeing that in the income statement. So you're seeing this isn't growing any faster. Their pre-tax income hasn't grown despite spending billions of dollars in acquisitions. So this is a $27 billion company, but when you put it into your cash flow statement, cash from operations is $500 million. So you're paying, 50 times plus cash from operations for this company, and it's only growing 10% a year. This is going to end poorly for investors. So I like this company. I think it could be a good watch list company. You see these margins are amazing. Everything you see here from a business quality standpoint is good. You have that lock-in. You have high, stable margins. You have 20 straight years of profitability. Everything there is good. High quality company should go on my watch list. However, this price is simply too high. So this price is probably 4 times higher than what I'd want to pay. I like buying stocks at a 15 PE, and the PE here is 60. And so what is the price compared to 310? So you need to pay for, this needs to be a price under $100 per share. It probably needs to be a price about $80 per share. I'd probably get interested in this company about $80 per share, something under $100 per share. It's just simply too high priced in this market to consider. And it's not like they're growing revenue at 30-40% a year. They cannot work off this PE ratio with these growth rates. You need to be growing much, much faster to justify a PE of this high, and they're simply not doing it. So for me, ANSYS is a pass on valuation because the company's overvalued, but it should be added to my watch list because it does have a lot of appealing standpoints. Stable gross profits, high, long period of earnings, double-digit returns on equity, all sorts of things like that. There's a lot of potential here, but it's simply too high priced. Thank you for listening. Don't forget to like this video and hit that subscribe button. Ring the bell so you get notifications as I upload new videos. Thank you for listening, and until next time, stop paying fees, start building wealth.